Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is July 18th, 2024. And today on our call, we have the CEO, Jeff Swainson from Simply Solventless Concentrates. Simply Solventless trades on the TSX Venture Exchange under the symbol hash, and it also trades on the OTC under SSLCF. The company is currently trading at 33.5 cents with about 69 million shares outstanding, or about a $23 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Yeah, great to have Jeff back. Exciting times for you, Jeff. Exciting times for us as shareholders, and really, big sort of potential inflection point for your business in this acquisition with CannMart. So we thought we'd have you on to talk more about that deal, talk a little bit about the business, just in general for those, especially the relatively new to the story. But why don't we just hand it over to you? Maybe just remind everybody a little bit of what Simply Solventless is all about, and then we dive right deep into the acquisition.
Sure. So Simply Solventless, at its core, is a solventless concentrates manufacturer. We distribute into the retail channels throughout Canada, and primarily into Alberta and Ontario, and also some of the smaller provinces. But essentially, we were founded in 2020, on July 10th, actually, which is actually a cannabis holiday. We did that by accident, but throughout the first 3 years of our existence, it was obviously very tough going. We founded the company at a time where the industry continued to roll over, and it's kind of built a scrappy attitude in us, and every dollar matters attitude. And so really what we've been trying to do over the last few years is build credibility. I mean, it's really about credibility for us, not just with consumers, of course. You need credibility with consumers, but with investors, and also with other licensed producers. So that's really the theme of this presentation is bringing credibility to cannabis. Our mission is to provide pure, potent, terpene-rich, ready-to-consume cannabis products to discerning cannabis consumers. And really what that means is that our primary way to connect with the consumer is first through product quality, but second with convenience. I mean, obviously, consumers right now, they base almost all of their purchasing decisions on price and potency, but convenience is also very high up on that list. So that's what ready to consume essentially means for us. And this is a broad summary, and we'll look at the summary again at the end, but at the highest level, our strategy is to drive organic revenue growth with our in-house brands, those being Astrolab and Fruity Hootie. I'll get more into the brands in the following slides. And to build a track record of opportunistic acquisitions. And so the first acquisition we made was Lamplighter in January 2024. Of course, now the focus is CannMart. We've entered into a services and acquisition agreement to acquire CannMart Inc. And that's, of course, a transformative acquisition for our company. In terms of the company itself, 2023 was a transformative year for us in itself because we launched our first brand, Astrolab. We had 7 million revenue. We had net income profit. During 2023, we eliminated about $9 million of debt that we had on our balance sheet. And essentially that allowed us to go public. We had always aspired to go public. And it was always part of the plan. But when we originally acquired our facility, we loaded up with about 6 million debt in the form of a vendor take-back mortgage. We had about a $2 million royalty. We had 1.2 million of convertible debentures outstanding. And so that wasn't a picture that was going to get us even approved to go public, in our opinion. And so we worked hard. We did a sale leaseback of our facility. We eliminated the 8 million debt, so the VTB and the royalty. And then we did an equity offering that eliminated all the convertible debentures. And so that allowed us to go public in December 2023. And so 2023 was really our initial year out of the gate as an independent licensed producer. As I said, we did 7 million revenue. And in Q1, we did, on an annualized basis, 12.4 million revenue. So strong growth from 2023. And we had net income in Q1, pretty strong net income of about $550,000, which is it's very hard to achieve net income profitability in the cannabis industry. We gave Q2 guidance of 4 million revenue and 750,000 net income. So annualized 16 million revenue and 3 million net income. And so we're on a trend of revenue growth, but more importantly with profitability. Of course, now, just at the beginning of this week, we closed the equity offering, and we'll get into use of proceeds in more detail later. But we went out on a private placement of units for 3.5 million, 25 cents a unit with a half warrant at 40 cents. And that was, of course, to fund the CannMart acquisition ultimately, to bring hydrocarbon extraction in-house, and to fuel CannMart sales with inventory and working capital. And so this is the snapshot of the CannMart acquisition. So for some background, CannMart is a licensed producer. They're owned by an entity called Lifest Wellness Inc. And they had two subsidiaries, Lifest that being. They had CannMart Inc. and CannMart Labs. And around February, CannMart Labs went into CCAA. And so Labs, of course, had debt, and they had a lot of the processing taking place in Labs. And CannMart Inc. essentially had all of the provincial product listings, basically generating the revenue, and also a small licensed facility near Toronto. And so we entered into an agreement with Lifest to first of all run CannMart Inc. So to take it under our umbrella and operate the entity, and then ultimately to acquire the entity. So we have a definitive purchase and sale agreement that we've executed that now is out for shareholder approval, with the meeting being in early September for Lifest. And so the reason that we wanted to pursue this acquisition was Simply Solventless is predominantly solventless concentrates. That's what we started out as. We've expanded into infused pre-rolls and vapes, but the largest part of the concentrates market by far is hydrocarbon concentrates. We were looking at bringing hydrocarbon concentrate manufacturing in-house, and we needed distribution. And so we were looking for an opportunity to acquire distribution essentially with a proven stream of revenue, so that we could capitalize on our hydrocarbon in-house manufacturing. And that's how CannMart came to be. So essentially we negotiated a good deal for all parties with CannMart. The purchase price is $2 million, comprised of a $500,000 cash payment at closing, 500,000 of units on the same terms as the financing we just closed, and $1.5 million vendor take-back mortgage at closing. With that, we received 500,000 of inventory. So net, it's 2 million purchase price. There's a bonus payment structure, whereas if CannMart Inc. does more than 12 million revenue over the next 12 months, we'll pay 20% of that revenue in the form of an additional VTB. And so that just de-risked the upside of the transaction for us. It basically, CannMart, when the other subsidiary, CannMart Labs, went into CCAA, the resources tightened up for Lifest, and they couldn't deploy the resources that CannMart Inc. needed to service all of its revenue. So their inventory levels dropped and their revenue dropped. So the revenues dropped from basically steady state 1.8 to 1.9 million per month to around the 1 million per month level when we entered into this deal. And so on an annualized basis, that's 12 million. So anything above that 12 million, we pay a bonus on. Of course, they're arguing that it's a $20 million revenue business per year. But with that reduction, we wanted to kind of mitigate our risk on the acquisition. So that's why we set it up as a bonus payment. Overall, the structure works out to 0.18 times gross revenue multiple on the acquisition, which which we find to be an attractive valuation. We're essentially acquiring 20 million annualized revenue once we deploy capital and get the inventory in there and get it ramped up again. And on a per share basis, it's really what matters the most to us. And so at exit 2024, we believe that this deal will add 154% revenue per share growth and 124% net income per share growth. And ultimately, that takes us over 40 million a year annualized revenue at exit of 2024 and 6.2 million annualized net income. And so, when we started last year, we were happy with 7 million as a goal and a target in 2023. And so, of course, this represents substantial growth for our business. But we have demonstrated an ability to execute and to focus on costs and to run a lean business that really is driven by fundamentals. We're trying to bring fundamentals and strong capital stewardship to the industry. And I think that's the primary reason why we're able to enter into deals like this, is because predominantly deals in the cannabis industry nowadays are vendor financed. And so the vendor won't do business with you, assuming they're not in CCAA. They won't do business with you unless they believe you can execute and you can do good things with the business and ultimately pay for it. And so that's, I think the credibility that we've built in that regard with our results has led to these opportunities. And so you can see here, in terms of revenue, it's this, strong growth. CannMart takes us up to potentially over 40 million exit. It's about 59 cents per share revenue, up from 23 cents per share in Q1. And we're looking to exit at annualized 9 cents per share net income, up from 4 cents per share that we achieved in Q1 2024. And so with CannMart, on a pro forma basis, we have our two brands, Astrolab and Fruity Hootie. Astrolab is pure solventless concentrates. It's a connoisseur brand, offers ultra premium products for very, very fair pricing that actually is in many cases cheaper than the black market. And that's what we're trying to do with Astrolab is we're trying to give consumers that are participating in the black market an opportunity to try products in the legal channel and to ultimately convert them. And then Fruity Hootie is amplified solventless. So we're doing blends of live rosin and distillate and terpenes and making very flavorful products that still bring that full spectrum experience, which is important to regular consumers. And then Lamplighter, we acquired the Lamplighter brand in January 2024, as I noted. It's ultra high potency distillate products that are very, very flavorful. The vapes are over 90% THC. The infused pre-rolls are around 50% THC. So very, very high potency and very fair prices, which are, as I said before, the two primary buying criteria for consumers in the legal channel for cannabis. And then Zest Cannabis is also coming with CannMart. It's very high potency hydrocarbon vape cartridges and disposable vapes. And then Royalty. Royalty, it was CannMart's primary brand. Very successful brand. It's the #1 concentrates brand in Manitoba and Saskatchewan, #2 in Alberta, and #8 in Ontario. And so with this acquisition, that's really the brand that we were focused on. With Astrolab and Royalty in particular, we have a full breadth of product within the concentrate space. And essentially, between Royalty and Zest, we add about 70 product listings to our portfolio. And that's really why we're able to achieve these revenue increases with these acquisitions, is because we're acquiring SKUs in market with the various provinces. So you can see right now, or at the beginning of the year, we're about 0.3% market share. whereas the leaders are much, much higher. Decibels at 7.5. They're in second place. They've done a fantastic job with connecting with the consumer. But we think that, at the beginning of the year, we had basically no listings at the beginning of 2023. We built Astrolab up, as you can see here. The pink is Fruity Hootie. We layered it on. We launched it in November 2023. And so our two in-house brands, Astrolab and Fruity Hootie, they've both experienced very strong growth. If you look at the headset data, it's a very, very nice linear curve of growth. Every single month, basically, it's growing, organically capturing market share. And that's what we want. We want nice, steady-paced growth with our in-house brands. And you can see Lamplighter coming on. Ultimately, Lamplighter, we think, would take us up to the 70, 80 listings in total with our in-house brands. But then Royalty and Zest and Relax, which is the third brand that we're acquiring from CannMart. We think that we'll exit with over 140 product listings. And ultimately, our goal is to be over 1% market share at the end of the year. And so, with acquiring CannMart Inc., it's really transformative to us. It more than, triples our planned market share by exit of 2024, and really sets us up to be a meaningful participant in this industry. And another use of proceeds for us with this financing is to bring hydrocarbon extraction in-house. And so we currently use a lot of distillates and hydrocarbon products in our brands. And then, of course, CannMart is a hydrocarbon extract focused or brand house, essentially. So we'll save significant capital on our current portfolio. Plus, when we're plugging in CannMart's 70 listings and bringing hydrocarbon extraction in-house, we believe that the overall benefit will be about $1 million a year to cost of goods sold. So that'll help drive solid gross margins and profitability, which is, of course, that's number one for us. And it all distills down essentially into results. I mean, we've achieved profitability that has not been seen yet in the cannabis space that I'm aware of. Maybe some private entities are achieving those kind of profit levels. I believe our Q1 and Q2 projected net income percentage is about 18%. And of this peer group in the comp table here, you can see the average is -5% net income. And so we're planning to exit 2024 at 15% net income, which is obviously substantially higher than this peer group and a leader in profitability. And then in terms of valuation, on an enterprise value to adjusted EBITDA basis, pro forma, we're projecting to exit at about 2.5 times at this price. So at 33.5 cents per share, it works out to about 2.5 times adjusted EBITDA. And of course, the average is 7.9, even among peers that have not demonstrated nearly the levels of profitability that we have demonstrated. And generally, also, the peer group has an average debt load of about $16 million. We're currently zero debt. We'll have the $1.5 million vendor take back when we close the acquisition of CannMart. So we'll have substantially less debt than average. Yet we're still trading at significantly below market in our view. And this is really a snapshot of our history and why we believe that we're here. And it's all about results. It's all about that scrappy, every dollar matters attitude and the focus on the business and the fundamentals and being lean. I think that those results that we've achieved have led to credibility, and the credibility has brought us opportunity. So you can see we received our licenses in June 2022. Then we listed our first products, which was Astrolab. Those launched in May, and those results allowed us to do the sale leaseback of our facility. So in August 2023, as I said, to eliminate the debt, we did the sale leaseback. So we sold it to our facility to a private group of investors, and then leased it back on a 5-year lease with a 10-year renewal option. And then that allowed us to convert all of our convertible debentures with the equity offering, and then we launched Fruity Hootie. And so really we're just building on results. We didn't launch the company and raise $100 million, and when capital's easy to raise, they say it's easy to waste. And we didn't have that luxury. We've been lean right from day one. And so by the time we got public, we were running a very sound business with good profitability, which allowed us to acquire Lamplighter. And then we achieved record monthly sales, and then that led to meeting you, Paul and Trevor, and to doing our 800,000 financing in April, which fueled the Lamplighter sales. We used that for inventory to deploy into Lamplighter, which we acquired, and to drive revenue with that brand. And then, of course, we continued to execute. We built our revenue to 4 million projected for Q2, with 3 million annualized net income. And then that led us to being able to do a deal with CannMart, and then ultimately to the financing that we just closed. And so I think that with results and a focus on results, and we'll have the credibility to continue to capture opportunities that come. Obviously, the environment still brings significant headwinds. A lot of people were hoping for excise reform in the 2024 federal budget. That didn't happen. And I think for us, that was an inflection point, because had excise reform happened, barring any price compression, I think that the large LPs would have had a lot of free cash flow, and they probably would have looked to consolidate a little bit faster than they are now. But without that excise reform, they're still not profitable. Most LPs are just not profitable, and in a lot of cases not in a position to make acquisitions. And so in that event, it led us to being in the position to pursue acquisitions, since we are profitable even with this excise regime. And those opportunities are coming our way, and we're diligently evaluating them and looking to continue to do so. And then our cap table, so 69 million shares out roughly, fully diluted 107 million, predominantly warrants outstanding, about 31 million warrants, or 33 million warrants, sorry. Exercise at 20 cents, except for the round we just closed. Those warrants are 40 cents exercise. So those warrants are in the money. And we have working capital of approximately 7.5 million post-closing of this financing. And then in summary, again, we're building our in-house brands. We're achieving very good revenue growth with those. We're making opportunistic acquisitions. We now have 6 straight quarters of net income profit, which it's up there in terms of LPs. I don't know of any that are on that kind of a run. We currently have no long-term debt, significant revenue growth, profitability, and we're trading at a 2.5 times adjusted EBITDA.
Perfect. Listen, Jeff, thank you for that. Remind everybody that's listening, I know we've already got some questions coming in, but if you have some questions for Jeff, please let me use the chat function, then I'll ask a question. Okay, so this is great. I mean, part of the whole reason why we got excited about investing in the company to begin with was that, of course, you guys are profitable, but really we were looking for a platform that could go out and do exactly what you're doing here with CannMart, acquiring assets that are somewhat distressed and with somewhat limited competition, going out and buying these things for more or less pennies on the dollar. Maybe are you able in any way to give a sense of what was the cost to get this type of asset to where it was, and in relation to what you're buying it for?
I don't know the exact figures, Paul, but there was significant amounts of capital deployed into the business, without question, in the tens of millions of dollars. And of course, weren't able to ultimately achieve profitability. I mean, for many, many reasons. Obviously, the excise taxes are punitive. The competition has been fierce. The price compression that's been seen over the last 4 years has been epic, with lots of licensed producers at times willing to sell product at a loss. And so, of course, everyone was making decisions with the information they had at that time. The market wasn't quite understood. And so, of course, there's a lot of reasons for why these things happen, but we're positioned now to capitalize on those opportunities. And this deal, what we like about it is that it gives Lifest a lot of upside with our stock. It gives them some cash to focus on their new business, new direction that they're going. And so, we believe it's a very, very good win-win situation for all parties. And ultimately, we believe, we make promises to people, including CannMart in this deal, and entering into a VTB mortgage with them. We need to repay that and work hard to make sure that we execute on this deal and integrate these assets into our operations efficiently and effectively.
Mhm. Now, one of the things when Trevor and I had the opportunity to come and do a site visit there, one of the things that really struck us is that you had a significant amount of capacity still that you could sort of utilize. And maybe talk a little bit about that. You guys are taking on these assets, and a fair bit of that capacity is going to be utilized here. So you are, I mean, there's some real synergies from using that unused facility or underused facility and bring the stuff in-house. Maybe let's talk a little bit more about exactly what that does for the business.
Absolutely. And so the synergies are substantial. If you look at on a business segment basis, in the Lifest financials as an example, the CannMart business segment did 2 million of expenses, not including cost of goods sold, but 2 million of below the gross margin line expenses in Q1. The synergies that we're achieving in this deal that we're currently working on is we're going to reduce those from 2 million a quarter to about 500 to 600,000 per quarter. And so those expense reductions are across the board in terms of all types of resources. Of course, people. Unfortunately, we are, right sizing the business to a degree to make sure that we capture the synergies there. Things like office expenses, just simple things like that, we're reducing from about 278,000 a quarter down to 50 or 60,000 a quarter, and the marketing side of things, we're reducing from 800,000 a quarter down to about 400,000 a quarter. Another large synergy that we're capturing here is right now CannMart is using exclusively third-party co-manufacturing.
Mhm.
And so, as you noted, we have a lot of unutilized capacity in our facility right now in Alberta. So our facility is currently running at about 25% of our what we believe is our revenue capacity in the facility. And so we're going to transition a lot of these activities that are currently being done by third parties into our Alberta facility. Things as simple as vape filling. That's going to save $1 or $2 a unit for vapes, and that's material. The cost savings and the benefit to gross margin in those cases is substantial. Obviously, we're running fixed costs within our facility. We have, fixed monthly salaries and labor costs and utilities. That's just being spread over a larger breadth of revenue. And so, the revenue and the revenue is obviously substantial. There's substantial revenue capability here with CannMart, but the cost savings are equally substantial for us. And that's before we even start talking about hydrocarbon and bringing it in-house, which we're doing. The price for hydrocarbon concentrates in the market right now is somewhere around $4 a gram, wholesale bulk. And we think our manufacturing for that will be basically half of that cost. And so when you're plugging 70 provincial listings with the brand royalty and zest of popular products that move significant volume, and you're having those kind of per unit savings, it adds up quick. And so for us, the opportunity to to reduce the expenses of the CannMart facility in Ontario, and to use it predominantly as a shipping and logistics hub for our Alberta operations and CannMart operations, and the ability to bring a lot of these services in-house into our Alberta facility and increase the utilization from approximately 25 to 50%. Those are meaningful for our business. And so we believe that, acquisitions such as this that don't come with debt, a lot of them do come with debt. This one, doesn't come with debt. It comes with actually working capital, and it comes with listings. That's what we're focused on, is acquiring listings, acquiring revenue, and then utilizing our current infrastructure to reduce the costs and ramp the revenue.
Mm-hmm. Now, correct me if I'm wrong. This is me reading through the presentation here. Your cost for your hydrocarbon equipment is going to be in the sort of $750,000 range, but immediately within a year, you've got about $1 million worth of savings that produces. So technically, less than a 1-year payback on this equipment. Am I right on that?
Absolutely. We're projecting approximately a 9-month payback, but that's only based on the savings that we generate from that equipment on our branded products. There's also a very vibrant live resin wholesale market between two other licensed producers. Some of that resin is even going internationally. And so we haven't even factored in any wholesale B2B business with this equipment in that 9-month payback period.
Mm-hmm. And the other thing that this brings to you too is I believe you're not currently in BC with your products. This brings you into BC, does it not?
It does, but in a fairly small way.
Mm-hmm.
BC is very, very challenging to get into. As you noted, we're not in BC yet. They really do focus on BC producers. Royalty is currently in BC, but in a fairly immaterial way. So hopefully it gets our toe in the door. We've been working with the BC LDB, for quite some time to get in. We have a lot of demand from retail there, from stores saying that they want our products. And so I think for us, with or without CannMart, it would have been a matter of time to get into BC, but certainly this can only help.
Mm-hmm. And then what I should have really said is there's some other markets as well, because I believe this takes you into Quebec with a number of SKUs as well. So really what I'm trying to get is CannMart now gives you a little bit more geography, more markets to get into. You wedge your foot in there and you can bring some of the other products in there as well, is my understanding.
No question. So predominantly, as I said, we're Alberta and Ontario right now. But CannMart with Royalty is #1 in Manitoba and Saskatchewan for concentrates. So it immediately gives us a #1 concentrates position in those two provinces. We're already working to get our current Astrolab and Fruity Hooty products into those provinces, but this immediately accelerates that whole process. They are in Quebec through their Relax brand, which is predominantly edibles and some blunts. So it gets us into Quebec in a very timely manner. It gets us into the Maritimes, which we're not currently in. It gets us into some of the territories, which we're not currently in. So there's no question additional markets that this brings on for us, and it accelerates the process of us, with Astrolab and Fruity Hooty getting into those provinces because CannMart's already registered.
Perfect. And there, I don't know how much you talked about it during your presentation right now, but I know in past we've had a lot of discussions around this. There's an advantage with excise tax, or at least you believe there's going to be an advantage with excise tax with this deal. Can you explain what you explained to me in the past? Why does this help you when it comes to excise tax?
And so there are potential savings with entities that have multiple LPs with excise taxes, just because of how it's billed, and selling wholesale between entities. So I mean, I guess the best way to put this is that if you look at our excise right now, we're paying about 43%, and CannMart is paying 35% before this deal, and so they should be paying more excise than us because their products are predominantly higher potency than our Astrolab and Fruity Hooty products. And so that kind of illustrates some of the things that can happen with excise is, we're hoping certainly, and we'll work to try to get our excise down to that 35% level as well.
Now, I think the question that's come back to us when we talked about this deal to investors, probably more than anything else, is Life has had this asset, or CannMart will say, doing $20 million a year in sales, drop down to 12 million. I know you mentioned in the presentation here, it's a working capital issue, but I really wanted to emphasize this and make it clear. They basically didn't have the money to put product on the shelf, correct? I mean, the demand was there. They just couldn't put product on the shelf, and it was almost like the more they sold, the less product they can put on there because they're losing money. Let's talk about that a little bit more. Clearly, the reason for the raise is to make sure that doesn't happen to you guys. You guys now have a significant amount of working capital to make sure that doesn't happen. Let's talk that through a little bit more.
Absolutely. And so, through discussions in our due diligence process, that was the primary focus: is can we get revenue up again? And of course, that's why we structured the deal with a tranche one, call it, and then the bonus payment of VTB as we're able to achieve higher revenue levels again. But in discussions with key accounts, all of the retail chains that carried the majority of Royalty and Zest's products, they're all telling us we want these products, and we just can't buy them. We just can't buy them anymore. And if you also look at the inventory levels of CannMart, they've been declining significantly. And so, through our due diligence, we gained a lot of comfort that with the appropriate working capital and deployment of that working capital into inventory, that we'll be able to ramp these sales up again. These are popular products. Royalty is the #2 concentrates brand in Alberta, and that doesn't happen by mistake generally. And so we're very confident that we're going to be able to ramp the sales back up to the prior levels. And as you noted, it's because of this financing. We're going to deploy a substantial amount of this working capital into the inventory, and we're going to work with key accounts and make sure that the provinces are stocking their warehouses appropriately so that they're available for key retail chains.
Fantastic. Okay, let's jump onto some questions that have come in, and then I can come back to some of my questions. Okay, so only a third of cannabis consumers claim a favorite brand. Therefore, the majority of cannabis consumers are constantly trying new products and SKUs on the shelf. Is one of the greatest challenges facing cannabis companies winning new consumers and converting the new customer into a loyal customer?
Yeah, that is the biggest challenge. The data does show that there is relatively low brand loyalty. And that's why we were interested in Royalty, because it is one of the few brands in Canada that has brand equity in our view, along with Astrolab, really. I mean, Astrolab is also developing brand equity, but you have a lot of turnover in customers. It's hard to retain customers without question. And in order to do so, you need to have a differentiated product. And with our ethos going back in time from day one, being solventless. Solventless is very hard. You have to understand the consumer and what the consumer wants in order to execute solventless well. And that's, our team we have an incredible group of people that are passionate cannabis advocates and that are master hashishans, and they understand what the consumer wants. And so while it is hard to develop brand loyalty with consumers in the industry, we are developing some loyalty with Astrolab, and certainly Royalty also has that now. Another thing for us is that we've always looked at the cannabis market in Canada somewhat as an 80-20 rule proposition. It's you have 80% of the products being purchased by 20% of the consumers, and most of those 20% of the consumers are still shopping in the illegal channels. They're not even in the legal market yet. They didn't have products that were priced fairly compared to the black market to win their loyalty. And with our brands, that's one of our mandates: is let's bring people into the legal channels, because there's wonderful products in the legal channel. They're safe products. They're obviously fully tested, and now the prices are competitive with the black market. And so I think that a lot of the reason why there's been such low loyalty is because a lot of the consumers today aren't habitual cannabis consumers. They're not everyday consumers, and so we're bringing everyday consumers in, and we're building customer loyalty with everyday consumers, and those are the 20% that consume 80% of the products.
Mhm. So, I mean, I know there's restrictions around advertising and sort of brand awareness, but what can you do? The questions come in as, what is Hash strategy to create brand loyalty? Now, you mentioned about sort of quality and making sure that you know what the consumer wants, but is there anything outside of that that you can do? You followed on by saying, can Cash create a Marlboro Man?
No, you can't. That's definitely prohibited. And so what you can do is a lot of events. And so you can connect with a lot of consumers, a lot of bud tenders at a lot of different events throughout the country. And then the bud tenders that work at the retail stores can promote your products. Um, you know, Really the number one way to do that, Paul, is through the product quality. Advertising regulations are very, very restricted. So, aside from logos and typical standard brand assets that you can put up into retail, there's not a lot that you can do. There's definitely a disparity between other regulated products such as alcohol and cannabis. And we believe over time the pendulum will swing into a more reasonable territory. Of course, right now, out of the gate with legalization, the mandate was safety number one. And so we understand why the regulations are like they are. And until that changes, it's just about product quality. It's about providing a value proposition to a consumer. It's about providing a good product for a good price and having fun with it, right?
Mhm.
Providing good experiences to people.
Mhm. You sort of answered some of the questions here, but I'll say it again here. Is price a key selling point? Is THC a key selling point? And is the idea sort of the ideal product one with high potency and low price?
Yeah, and so that's what's driving almost all buying decisions now.
Mhm.
But as I said, if 20% of the consumers, whether they're in the legal or illegal channel, are buying 80% of the products, the other 20%, the other 80% of people are buying 20% of the products. And that's where we see the current market. Like those are the people buying on price and potency because people need something that's quantifiable. People want to understand what they're buying, and numbers are a way that they can think that they're getting a better product. But the reality is that full spectrum, in our view, is what matters. And so full spectrum means so it's not just about THC, it's about the terpenes, the flavonoids, and it's called the entourage effect. Different profiles of terpenes mixed with THC give different effects and different effects for different people. And so when you try full spectrum products such as Astrolab, Fruity Hootie, Zest, Royalty, Lamplighter not so much because it's a high ultra high potency flavored distillate. So it's focused on that, high potency, low price consumer. But but consumers of cannabis that consume cannabis every day and that it's part of their life and they're part of the lifestyle and they live it every single day. It's all about the full spectrum experience. So whereas, a distillate vape might have 90% THC, a full spec vape might have 75% THC, but it'll have, 8 or 9% terps and a terpene profile that for a lot of people gives a much, much longer lasting and better effect than the high potency, low terpene type products. And so we have products to meet the consumer at various places where they want to shop, which at this point it's all about price and potency. We have products such as Lamplighter to provide great products for those consumers. But we're a believer that the market will evolve with education and with experience to a place where consumers are looking for full spectrum, high quality products.
Mhm. And then, apart from getting the customer to want this, you obviously have to get it on the shelf first. How does Hash win and retain shelf space?
And so that's just about relationships with key accounts. We work with a lot of independent stores as well. But the landscape in Canada is that the market is dominated by very large retail chains across the country. And so if you aren't able to have relationships with those groups, then it's very hard to get onto shelves. Um, and so Jeff Lawrence, our chief commercial officer, we brought him on in January this year um, as VP sales at the time. He's done a fantastic job connecting with the key accounts, the key retail chains, and getting all of our brands on the shelves. One of the things that's happened as a result of the headwinds faced in the industry and the capital constraints is that a lot of the licensed producers aren't able to pay their bills, and that includes, key account bills. And so we're finding that a lot of the key accounts are almost looking to transition away from some of the brands that they've had on the shelf for a long time and to start to work with new groups. And so we're certainly a beneficiary of that, whereas we came in a bit later and potentially can capitalize on some of those situations and any further CCAAs that happen, even if a company goes into CCAA and it's going to come out and still maintain operations, it's still a disruption. It's still a disruption for the retail chains. It's a disruption for everybody. And so we've seen, we've been the benefactor of some of those situations as well with entities going into CCAA and losing some credibility with the retail. Again, it's about credibility. The cannabis industry has a credibility problem. If there's one thing to define, you know, the issue that the industry is facing, and especially in Canada, is credibility. And there's many reasons why credibility has been hard to achieve, but at the end of the day, if you don't have results and credibility, you're not going to have a lot of opportunity. And one of the opportunities that's come our way as a result of our credibility is these key account relationships and being able to access shelf space on an expanding basis.
I got to imagine it doesn't hurt now to have another $3.8 million in the bank as far as credibility for a lot of accounts, when a lot of your other competitors are out there with the opposite effect. So
Absolutely.
so that should help. And then one more question from Earthrise here is why do cannabis companies constantly introduce new products?
And that's because it's hard to differentiate, and it's hard to develop loyalty. And so a lot of entities are trying to essentially get initial load-ins of new SKUs, because the initial load-in with retail is much bigger than the recurring monthly orders. They'll load in, 2 or 3 times the typical amount on the first order all the time. And so what you'll see is a lot of entities trying to have initial load-ins, and then they'll drop ineffective SKUs and then do initial load-ins, and it's just this revolving door of initial load-ins. And that's obviously, not a long-term value proposition. You need to have SKUs that are core SKUs and key retail that are adopted by the consumer and that get traction long-term, to where you're not having to always launch new products. So that being said, there is also new products being launched all the time because of innovation. There's simply innovation. I mean, there's incredible products coming out that are novel, that haven't been seen in the world before. And so there's a lot of cases, where it's just innovation, and it's trying to provide the consumer with an experience that they haven't had before. And so, yeah, I guess there's multiple reasons for that, Paul, but assuming that you can connect with the consumer and you have good, strong SKUs that are resonating, you don't always need to have new SKUs, but you do, new flavors is important, keeping it fresh. It's there hasn't been many Budweisers, so to speak, in the industry for cannabis, where people just go and buy their Budweiser. It's people do want something different. They want to try something new, and they're also experimenting with cannabis, overall, and they maybe don't know what they like yet. And so you kind of have to adapt and meet consumers where they are, and be innovative. And that's really Solventless is really, even though Solventless is the oldest kind of extract, thousands of years old, is hash. That's what really Solventless is all about. It's hash at the end of the day. Even though it's so old, really in the legal channel, it's the tip of the spear on innovation. It's it's novel products. It's very high quality products, and it's products that really resonate with consumers, with longtime cannabis consumers, and so being a solventless company at our heart, that brings the innovation that we need to bring those consumers into our portfolio.
Perfect. We've got a lot of questions coming in here, so I'm going to try to rifle through as many as I can here. So one of our members from Quebec actually asked, are there any products in Quebec? We've already answered that question, but a different question is, like, as far as like the current sort of capacity, how big could you grow with the current platform now that you have CannMart and the other thing? Well, I guess technically you don't have CannMart yet, but once you have CannMart, theoretically, how much revenue can you generate from the platform?
I mean, realistically, you have entities out there that are doing 7,500 million a year revenue just with predominantly cannabis 2.0 products. With our infrastructure, our infrastructure, could take us well over 100 million a year. Obviously that takes a lot of market share. But ultimately, we're going to look to drive growth of our portfolio of brands now. We have everything that a consumer could want on the cannabis 2.0 side. We're launching beverages and edibles in the fall, solventless beverages and edibles, which we believe have a lot of upside. And so we're not facility limited by any means right now. We have a lot of running room on our facility, and we still, even after CannMart, have unutilized capacity. So for us, it's going to be more about product category participation, what direction we're going to go, and the opportunities that we pursue on the M&A side. Obviously, dried flower is still the number one product category by far. About 40% of the product in Canada is dried flower. So that's an opportunity for us, to expand that way. There's opportunity on the edibles side with entities that are out there and very established, but ultimately right now, Paul, integration of this acquisition and making sure that we're doing a good job, that we're really truly capturing the synergies that are presented to us with this deal. That's first and foremost over the next few months. Beyond that, with the headwinds in the industry and the state of affairs that everybody is operating in, and with the track record that we've been able to establish with our results, acquisitions could be substantial in the future. And I think that the industry is ripe for a consolidator. Of course, we're not going to be going and buying, $200 million assets, but with most assets being financed on a vendor finance basis predominantly, it doesn't take huge amounts of capital to acquire large assets. Assets of the 50 million range, 100 million range, you don't need 50 million cash for those. And so, at this point, I think, being patient, making sure that we focus on accretive opportunities, and focus on opportunities that don't take exorbitant amounts of capital. And I think that we could achieve pretty substantial growth, not only with our current brands, but through opportunistic acquisitions.
Now, one of the conditions of this acquisition is a shareholder vote on behalf of Lifest. Have you had any indications of what the likelihood of it going through or not going through, and maybe when do you expect to know if the shareholders have approved?
And so, as it stands now, we don't see any reason why their shareholders wouldn't like this deal. I mean, of course, it's up to them, and they're going to vote. If you look at Lifest, stock price as an example. You know, they've announced their different direction that they're taking as a business. They've started to make some announcements in what they're doing in their operations. And it's been very well received by the investing public so far. Their share price since the deal was announced is probably up 300%, up to around the 18.5 cent level, whereas it might have been around 5 or 6 or 7 cents when we announced this deal. And so I believe it's being positively received by their shareholders and new shareholders interested in Lifeist. So I think that's encouraging. I think that given that we do have a track record and some credibility in the industry, and the fact that, you know, they have shares, they have units of Simply Solventless as part of the consideration of this acquisition. I think that their shareholders have a upside through the deal. Obviously, Lifeist, just like every other company in cannabis, can use cash, and there's a cash component. And I think that they trust that we'll be able to pay the VTB because, you know, we're generating net income profitability. And so everything indicates that you know, this should be approved. Of course, there's always risk that it wouldn't be approved, but you know, they did, you know, CannMart Labs went into CCAA in February. I don't know what the plans would be for CannMart Inc. if this deal fell through, but you know, I feel like Simply Solventless is probably a really good option for their shareholders in acquiring these assets.
I mean, from what I've seen, as far as Lifeist news releases since then, it's almost like their business plan going forward is kind of predicated on this deal going through. You know, it's less encumbered. The cash that you mentioned allows them to start sort of focusing on the other avenues of business here. So I would tend to agree with you there. Okay, questions come in here from Adamo. He says, what is the long-term gross margin expectation, and will there be more dilution acquisitions in the short run?
And so gross margins, I mean, typically you see 30% in the industry. We've been quite a bit higher than that. We've had a lot of good tolling deals. You know, in addition to our branded products, we have good tolling deals. We do B2B business, and so we've been able to drive solid margins. I would expect that we will have higher than market margins going forward as well, as we have in the past. I believe in Q1 we had 50% margin or 49%, something like that. And so, you know, that's really this every dollar matters mentality, and some of the tolling arrangements that we have on the B2B side of the business, you know, allow us to have those margins. And certainly we're going to continue to be tenacious and scrappy and be stewards of capital and make sure that we're not frivolous with our capital. And so I would expect that those margins will continue. And what was the other part of the question, Paul?
Well,
Sorry.
just dilution. I mean, I wouldn't imagine any other dilution unless you see another acquisition, but I imagine this is going to be, you know, there's some digesting you have to do here before you can focus on another acquisition. But then a little bit more to that too. There's a lot of warrants outstanding. So, and I understand there's been some exercise, which I think is great news. Maybe, I mean, do you see any need to get out there anytime quickly and raise more capital?
I don't see any need at this point to do another equity offering. Obviously, as you said, Paul, we do have warrants outstanding, about 33 million. About 26 million of those are in the money, 20-cent exercise. We are starting to see a lot of interest in warrant exercises and things like that, which, you know, for us, having that warrant overhang is obviously one of the you know, maybe things that people aren't excited about. But when you look at it from the perspective that, you know, we've closed this 3.85 million financing, we've been able to, you know, to do an acquisition to potentially more than double our revenue with only 500,000 of that capital, and using the rest as working capital financing. And then that we have, you know, call it, you know, 4 million of warrants in the money right now, if they were exercised. I'd be excited about any potential dilution from warrant exercises, because we've demonstrated an ability to capture highly accretive assets for very, very, very reasonable valuations with very little amounts of capital. So, you know, the opportunity that could come from these warrant exercises would be material in our eyes. And in terms of any possible dilution for things like mergers and acquisitions. I guess we would have to look at it on a case by case basis, but at this point, I would think that, generally speaking, we would have the working capital that we need to make acquisitions without any further financings. Which in my view would bring more opportunity and more potential acquisitions to us, because raising the capital for acquisitions is the non-starter for almost all potential deals out there right now. No one has access to capital. If we already have capital, that's going to put us in good stead.
Yeah, and clearly you've demonstrated if you can, put $1 in as capital and get $3 out, you take that money in all day long, right? So
absolutely,
no, for sure. Okay, so Joseph asks, this is an operational question, but how many months after finished good inventory is produced until consumers mention that the product seems old or they can detect a reduction in the product quality? What's a shelf life for this type of product?
That depends on a product by product basis.
Sure.
Things like pre-rolls that contain dried flower, the shelf life is much shorter. Things like live resin, it can be longer. For us, we haven't had any material issues with inventory aging on shelves. We've had very small instances of RTVs and things like that, which is a return to vendor, it's called. So we've had good turnover of our inventory in the provincial warehouses. And in terms of product shelf life in general, things like concentrates have a longer shelf life than things like dried flower or pre-rolls or infused pre-rolls. And of course, we participate in vapes, infused pre-rolls, and concentrates. So we don't see shelf life or inventory obsolescence as a material issue.
Perfect. Okay,
and I'll also note, sorry, Paul, I'll also note, we had a couple questions, coming through Q1. Oh, your inventory is rising. Why is it going up? And it's because we're planning acquisitions, and we're looking at things like CannMart at that time, and of course we hadn't announced it, but you doing revenue of 3 million in Q1, and our inventory was something like 8 million, call it. I can't recall exactly, but now all of a sudden, our inventory turnover ratio is going from something like 0.5 to 1.5 as a result of the deal, like the CannMart deal, and bringing revenue on and having that cost of goods sold requirement. So a lot of the reason for our ramp in inventory over that time is because we want to be prepared to service deals like this, and have some inventory that we need to service them, and then ultimately be in good inventory turnover ratio post acquisition.
Yeah, no, perfect. You obviously saw the next question, because that was exactly.
I didn't. I can't see the questions.
Okay, well, you nailed it. You nailed exactly. They were talking about the inventory increase and the turnover. Okay, so Adamo asked a question. We kind of talked about this a little bit, but if CannMart could not run the business properly, why is Hash going to be able to run it properly?
Well, and I don't want to say that they couldn't run the business properly. I mean, they have incredibly talented people there. I think it was, more than anything, just the conditions of the industry and the symptoms of the industry. And, we had the benefit of founding the company a little later than some of the other companies, and taking a bit of a different approach. And, we've been able to, ultimately, at the end of the day, we were 3 years wondering if we could make payroll, right? 2 a.m, trying to sleep, can't sleep. How am I going to make payroll? It's going on the credit cards, right? And as an investing group with, Bill McDonald, our co-founder, and a lot of our other core investors, we're funding it with our credit cards, and we're doing everything we can to survive. And when you have that instilled in you, you really learn to be stewards of capital. And that's really what it is for us. We take a very income-based approach to every decision we make. We make sure that we're making money on the deals that we're doing. We make sure that our products are profitable, and that we're making sound decisions. And it's not to say other people haven't made sound decisions, but we're a function of our environment, and that was a tough environment right from birth in this company. And so you know, it's kind of just instilled in us. It's ingrained in our ethos as a company and as a management team. And you know what? We have skin in the game. We, you know, in insiders, we're probably 22% now. You know, we've invested in every single round right from day one. We care about the outcome of this business, and we're not here to make huge salaries. We're not here to, you know, rake in a bunch of cash. We're here to have a win on the equity and to create shareholder value. And when our shareholders make money, that's when we'll make money.
Mhm. I always say successful businesses have at least had one come to Jesus moment. You guys clearly had your come to Jesus moment very early in your lives. Yeah.
We did. We did.
Yeah.
Yeah, no, it was tough. It was a grind for sure.
Yeah.
And, you know, obviously we didn't even own the facility originally. We acquired it and had all the debt and had to maneuver and, you know, be adaptable. And then of course, you know, going public, that comes with its own challenges as well. But, you know, I think adaptability is key and, you know, being able to foresee potential issues and then manage them and work your way through it and be solutions oriented. That's, you know, key to success in this business. And I think that's, you know, why we're here today.
Mhm. Jeff, what's your background?
So I'm a CA by trade. And after I got my CA designation, I went into oil and gas. Started at Chevron, my first job out of the CA firm. And then ultimately worked my way up to CFO of public oil and gas companies. And my last oil and gas company that I was with, we built it from 20 million to 400 million market cap during the 2015, 16, 17 downturn. And then got into cannabis after that. And so I guess to answer your question, Paul, I'm a bean counter.
I was going to say a numbers
I
guy,
feel
a
like
bean
one.
counter.
Yeah.
Perfect, perfect. I like guys that you know count cash.
Yeah. No, I
Um,
mean it's a, you know, it's a good education and
mhm,
you know our team broadly and overall, you know, obviously we have a huge amount of different backgrounds. We have, you know, engineers, Murray Brown in the facility, our VP Ops, you know, he's a 30 plus year engineer. Obviously we have, you know, sales professionals like Jeff Lawrence, incredible. Bill McDonald, our co-founder, he's an oil and gas landman. You know, he's probably been involved with taking at least 20 companies public and you know, used to do a lot of Joe Rotman's investments in oil and gas back in the day. You know, like we have a great CA. Jeff Hall is our CFO, and so you know, and in the facility we have, you know, passionate cannabis people. We have, you know, master hashishans who have devoted their entire life. You know, a guy named Braden McIntyre. He's literally just he is part of cannabis culture. He's very well known in the industry. And you know, a guy like Robbie Fisher, who's our sales manager, and you know, Luke Dixon. I could go on and on. It's the people that we have and the diverse backgrounds that we have and the different perspectives that we bring is a huge advantage for us. We're not all just CPG professionals, or we're not all just, you know,
yeah.
one mold. We're very different, and we have a lot of different views on things. And sometimes there's a lot of you know, excited discussion about stuff, but you know, we all get it out on the table and we find solutions to things, and we listen to different perspectives. And I think that you need that in a healthy industry, especially a new industry.
Yeah, no, for sure. Okay, so Mark asked, any color on recent pricing trends? That was a question I was going to bring up. Just generally, what do you see trend-wise in the industry right now?
In terms of product?
I'd say product and maybe even you know, raw material or legislation, anything that affects the business.
And so the industry since day one has been suffering from the decisions that were made in, you know, 6 years ago, 5 years ago. Entities were rewarded for building ever larger hybrid greenhouses. It was, I call it the funded capacity craze, where, you know, you'd go out, raise 100 million, you could build a 1 million square foot greenhouse, and then you know, you could get another 100 million and build another 1 million square foot greenhouse. And so obviously everyone was doing that. That was the only metric that was available, given that there was no actual revenue, no market understood to compare companies against each other, was funded capacity. And so obviously that resulted in a significant overbuild of infrastructure, way too much production capacity across the country. And way too much low quality cannabis being produced, in Canada. And so we had an oversupply problem. And it was an oversupply problem of low quality cannabis. And so at that point, what did everyone do? They went out and bought the biggest extraction machines they could to make the most distillate that they possibly could. And it really, the problem, the industry has been trying to solve its problems for a long time. And that resulted in serious price compression. That resulted in just punitive pricing, people doing anything to get product listings on shelves, get listings with the provinces. And on the B2B side of the business, the wholesale business, it resulted in very, very low prices. We're starting to see that old inventory that was produced as a result of the funded capacity craze is finally starting to be depleted. We're starting to see some crystallization in prices, if not slight increases, which is healthy. I believe on the retail product side that, as a result of the supply chain crystallizing and a foundation being built on prices that, I think the price compression on the retail side is likely coming to an end at some point here, in the relatively near future. And so I think we're finally starting to get into a little bit of an equilibrium and balance on supply demand within the wholesale and market, which should stabilize things on the retail side.
Perfect. Yeah. We're certainly hearing that from others as well here. Okay, so Trev from the UK says, if you're competing with black market, does this not create some difficult problems regarding security?
No, not at all. I mean, essentially, they're a completely different market to us, and it's just, any consumer in this country can walk into a legal retail cannabis store and purchase the product, and it's just about getting them to make that decision. And you do that over time. It's a long-term game. I think the latest data suggests that about 35% or 40% of customers are still shopping exclusively in the black market. 2 years ago, it was 60% still in the black market. So there is progress being made. People are being converted into the legal channels. And I think over time, it'll continue. That trend will continue because the options available in the legal channels are, it used to be a quality concern and a pricing concern. And on the dried flower side, the quality has come leaps and bounds in the legal channel from where it was 2-3 years ago. And on the cannabis 2.0 side, like the products that we sell, our products, we stand behind them against any product, whether it's in the legal or black market channels. And so, in terms of security risk, there's no further security risk. It's about just education and people realizing that our products are available on the legal channel.
Yeah. Gotcha. Okay, so Russell asks, and I saw this press release as well, does the June 27, 2024 news regarding Lifeist explores legal options regarding hedge fund settlement, does that in any way impact the deal?
No, so I'm not an expert on this by any means. I'm speculating, but I believe that they were being shorted. I think that they had a lot of pressure on their stock from being shorted, and there was a particular firm that may have been doing that, but that's the extent of my knowledge on that.
Yeah, no, fair enough.
If anything, I think they're suing the firm. So
yeah, that's exactly what's happening. Is they're trying to sue for potential damages against the hedge fund. So one last question has come in here. We'll take that and we'll work to wrap up here. But Paulo says, do you foresee remaining profitable for the quarters ahead? Is there any reason why you wouldn't be profitable here over the next couple quarters?
So the primary risk right now on profitability is integration and making sure that we're capturing the synergies as fast as we possibly can. We've already been capturing synergies. We're headed in the right direction. I would say that we're on target or even ahead of pace on rationalization and capturing the synergies. And so our plan is to have higher net income at the end of the year than we have now. We did 4 cents a share net income in Q1, and our our pro forma projected net income for Q4 on an annualized basis is 9 cents a share. So that's what we're working towards, and we're starting with that number, and we're working back, and we're making sure that we can hit it. And of course, if our projections change, we'll certainly keep the market apprised as we do. We've given guidance, which I don't think most entities have done in the industry. And so, at the end of the day, to answer your question, we wouldn't have done this deal if we didn't think we could have more net income at the end of the year than we do now. And so that's why we did it, and that's what we're going to, work extremely hard to achieve.
Perfect. Jeff, that sort of wraps up the questions. We always sort of throw two questions right at the end, and one is, so what as investors, what should we pay the most attention to right now, as far as any kind of metrics or maybe inflection point, a catalyst, anything like that? What do you think we should be watching out for?
Yeah, that's tough. I mean, I would say, obviously our Q2 results are coming up in August. I would say roughly mid-August. We haven't set a date. We'll inform the public of that date when we've crystallized it. But for us, it's about the integration. That's our primary focus right now. I think obviously in terms of the market, we could see some warrant exercises come in, and we'll keep the market apprised of that as well. And then I would continue to keep the pulse on CCAAs and potential M&A activity within the spaces. I think that can drive further opportunity for us. And ultimately, we've been very active, of course. We've been ahead of things, and we've been identifying opportunities, and we're always evaluating opportunities. But we really do need to focus on getting this integration done properly. This is a truly transformative acquisition. We're talking about more than doubling revenue. We're bringing on another facility. Our team has already been in Toronto, working with the CannMart team, which is now our team. We're all one team now, and so we've made huge progress there. But that's really what matters for us, because with our metrics right now, I mean, when we're at a 2.5 times adjusted EBITDA at exit on pro forma, I mean, we're significantly below the average of 7.9. In what world shouldn't a profitable company trade at a 10 times net income or more? And so we believe that the value proposition with our company right now, with the assets that we have in place and the CannMart deal coming in, the upside is there, and we need to leverage our past execution ability, leverage why we're here, why we've been able to achieve results, and to crystallize the value proposition that's in front of us and our shareholders right now.
Perfect. And Jeff, is there anything else that we should have mentioned, or is there, like, I mean, pretty well nailed it as far as the key message? What do you want to make sure everybody walks away with today?
I would just say, it really is about results, credibility, and opportunity. And we're on a cycle of those three things. And we believe that without the results, you will never have the credibility, and you will never have the opportunity. And we're going to continue to live with that mentality, and to make sure that we conduct ourselves in a manner that's going to generate results, because we believe in doing so, we'll continue to be uniquely positioned, and then we will continue to be a unique value proposition. I mean, obviously the financing, Paul, working with you and Trevor and your subscribers and everyone that participated in the financing was humbling, because in the industry, capital just isn't available, and we've been able to oversubscribe the two financings that we've done in the last 6 months, and we believe we've been able to put that capital to good use. And so, as a team, the public, and all of our investors and participants and your subscribers, please know, like, we're going to continue to work very hard. We care about this business. We want nothing but value creation for our shareholders, and that's what we get up to do every single day. And so, I hope that at the end of the year we can look back and see a fully integrated CannMart with on target exit at 40 million a year revenue, and who knows what we'll be able to do with those results moving forward from there. So I think the opportunity is big, and we're very, very excited to move forward and to see where we can take this company.
Mhm. And listen, we're excited to be alongside with you here. Jeff, thank you so much for joining us. We've been speaking with Jeff Swainson, CEO of Simply Solventless Concentrates, symbol is HASH on the Venture Exchange. Jeff, always good to catch up, and I'm very sure we'll be talking to each other quite a bit over the next little while.
Absolutely. No, it was a pleasure and honor to be here, Paul and Trevor, and thank you to all your subscribers for giving me the opportunity to talk today. And yeah, if anyone needs anything, I'm always just a call away.
Perfect. Thanks, and bye for now.